In today's fast-paced global economy, emerging markets are shaping the future of trade, investment, and innovation. Countries like India, China, Brazil, and Indonesia are rapidly transforming, offering businesses and investors new opportunities for growth. However, many companies and policymakers fail to recognize the significance of these shifting trends, often focusing too much on traditional powerhouses like the US and Europe. Ignoring emerging market trends is not just a missed opportunity, it's a serious risk that can lead to financial losses, competitive disadvantages, and long-term instability. From technological advancements to shifting consumer behaviors and geopolitical changes, those who fail to adapt to emerging markets may find themselves left behind in an increasingly interconnected world. One of the biggest risks of ignoring emerging market trends is falling behind in global competition. Many multinational companies and investors assume that developed economies will always dominate, but the reality is changing fast. Emerging markets are now home to the fastest growing middle class, with millions of new consumers demanding modern goods and services. For example, China and India alone contribute to nearly half of global economic growth, making them key players in industries like technology, manufacturing, and e-commerce. Companies that fail to expand into these markets risk losing out to competitors who are quick to adapt and invest. While Western economies face slower growth and aging populations, emerging markets offer youthful workforces, rising incomes, and untapped potential, but only for those who recognize these trends in time. Another major risk is a failure to anticipate financial and geopolitical shifts that are increasingly influenced by emerging markets. In the past, economic downturns and policy decisions in the US or Europe had the greatest impact on global markets. Today, however, the financial stability of emerging economies can trigger global ripple effects. For example, the Chinese real estate crisis and supply chain disruptions in Asia have already affected global inflation and trade. Similarly, political instability in resource-rich emerging economies can lead to fluctuating oil prices, food shortages, and major economic slowdowns worldwide. By ignoring these markets, investors and governments risk being blindsided by financial crises, sudden market collapses, and currency devaluations that can shake the global economy. Understanding and monitoring these regions is no longer optional. It's a necessity. Perhaps the most underestimated risk of ignoring emerging markets is missing out on the next wave of technological and industrial revolutions. While Silicon Valley has long been seen as the global hub of innovation, countries like India, South Korea, and Brazil are rapidly developing new technologies in areas like artificial intelligence, renewable energy, and fintech. For instance, India has become a global leader in digital payments, with millions using fintech platforms that rival those in Western countries. Similarly, China's dominance in electric vehicle production and AI research is reshaping entire industries. Businesses that ignore these technological shifts in emerging markets risk becoming obsolete as new competitors emerge with faster, cheaper, and more innovative solutions. The future of economic growth is no longer limited to the West. It is happening everywhere, and those who fail to recognize this will be left behind. The growing influence of emerging markets on global trade and investment. Ignoring emerging market trends is not just a risk, it's a strategic mistake that can have long-term consequences for businesses, investors, and even governments. As global economic power shifts, trade patterns, investment flows, and consumer behaviors are being reshaped by developing economies. These markets are no longer just sources of cheap labor or raw materials. They are becoming innovation hubs, digital powerhouses, and key financial centers. Countries like China, India, Brazil, and Indonesia are not only expanding their influence in global trade, but they are also setting new business models, consumer trends, and technological benchmarks. Companies that ignore these shifts risk losing access to the world's fastest growing consumer bases, the most dynamic industries, and the next generation of technological breakthroughs. Take, for example, the rise of China as a global trade leader. Over the past 2 decades, China has transitioned from being the world's factory to becoming a global economic powerhouse. With dominant positions in sectors like renewable energy, artificial intelligence, and electric vehicles, many Western businesses failed to anticipate how quickly China would move up the value chain. And today, companies that did not establish early partnerships struggle to compete. Similarly, India is rapidly becoming a leader in digital services, fintech, and artificial intelligence. With one of the fastest growing economies in the world, countries and corporations that fail to engage with these markets are not only missing out on lucrative opportunities, but they are also allowing competitors to gain a foothold in industries that will define the future. Financial risks, market volatility, and global economic shifts. Another critical risk of ignoring emerging market trends is a potential for unexpected financial disruptions. In today's interconnected world, economic instability in one region can have a domino effect on global markets. Historically, financial markets were primarily influenced by Western economies, but that is no longer the case. A debt crisis in China, a political crisis in Brazil, or an inflation surge in India can send shockwaves through global financial systems, impacting everything from stock markets to commodity prices. Investors who fail to monitor these markets may find themselves unprepared for currency fluctuations, inflation spikes, or sudden economic downturns. A perfect example of this occurred in 2013 during the taper tantrum when the U.S. Federal Reserve hinted at slowing down its stimulus program. This announcement triggered a massive capital outflow from emerging markets, leading to currency devaluations in countries like India, Indonesia, and Turkey. Investors who had ignored the deep connections between Western and emerging economies were caught off guard, suffering major losses. Today, as emerging markets play an even bigger role in global finance, ignoring them could lead to even greater risks. Those who fail to pay attention may find themselves on the wrong side of global financial shifts, losing money while more informed investors profit from the changing landscape. Technology and innovation, the risk of falling behind. One of the biggest dangers of ignoring emerging market trends is missing out on the next wave.